Ladies and gentlemen, let me begin with a question that sounds almost unbelievable. Could just 1 kilo of silver someday make you a millionaire? At first glance, it sounds like fantasy. 1 kilo of silver is affordable, tangible, and sitting quietly in the shadows of markets dominated by stocks, bonds, real estate, and even gold. But history teaches us something very important. The biggest opportunities often look small, boring, and even ridiculous before they become obvious. I don't want you to hear this as a prediction. I want you to hear it as a principle-based way of thinking about money cycles and value. Throughout my life as an investor, I've learned that markets move in long-term cycles driven by debt, currency creation, supply constraints, and human psychology. When these forces align, assets that were once ignored can experience dramatic repricing. Silver may be one of those assets. Silver is not just a precious metal. It is money. It is an industrial metal, and it is a strategic resource. Historically, silver has played a monetary role for thousands of years. At the same time, it is deeply embedded in modern civilization, used in electronics, solar panels, medical technology, batteries, and defense systems. Unlike gold, much of the silver that is consumed is not recycled. It disappears into products. When people think about making money in markets, they usually focus on predictions. They ask where prices will be next month, next year, or after the next news headline. But the reality is that meaningful wealth is rarely created by short-term forecasts. It is created by understanding long-term cycles and positioning yourself correctly before those cycles fully play out. This is one of the most important lessons I've learned from studying economic history and watching markets over decades. Every economy operates like a machine driven by credit, debt, productivity, and human behavior. When times are good, people borrow more, spend more, and take more risk. Asset prices rise, confidence grows, and leverage increases. Eventually, debt levels become too high relative to income, and the system begins to strain. To keep things going, policymakers lower interest rates and create more money. At first, this feels supportive, but over time, it changes the value of money itself. These are not random events. They are recurring patterns that have repeated for hundreds of years. We are currently in a phase where debt is high and the ability to stimulate growth through traditional means is limited. In such environments, governments and central banks tend to rely more heavily on money creation. This doesn't always show up immediately as consumer price inflation, but it does show up as a decline in the purchasing power of currency over long periods. When this happens, the real question investors should ask is not what will go up next, but what will hold its value when money changes. This is where the concept of revaluation becomes critical. Assets don't move gradually forever. They often remain undervalued or ignored for long periods, and then when conditions shift, they are suddenly repriced. This repricing can be dramatic because it reflects years of imbalance correcting in a relatively short amount of time. Those who benefit are not the ones who predicted the exact timing, but the ones who understood the cycle early and positioned themselves accordingly. History offers many examples. In periods when currencies weakened or monetary systems were questioned, real assets such as commodities, precious metals, and productive land experienced sharp increases in value. These moves didn't happen because investors suddenly became smarter. They happened because the underlying system changed, forcing capital to move toward assets that could not be easily created or devalued. The biggest mistake most investors make is linear thinking. They assume the future will resemble the recent past. If an asset has done nothing for years, they conclude it will continue to do nothing. But cycles don't work that way. The conditions that create the next move are often building precisely during periods of boredom and neglect. By the time the trend becomes obvious, much of the opportunity is already gone. Wealth, especially large wealth, is not about being right more often than others. It's about being positioned differently when the environment changes. That requires patience, emotional control, and a willingness to look wrong for a long time. It also requires understanding that markets don't reward excitement. They reward foresight. Rather than asking which asset will perform best this year, a better question is which assets are likely to benefit if the current monetary and debt trends continue. That kind of thinking shifts the focus from prediction to preparation, and preparation, not prediction, is what allows investors to survive volatility and capture the upside when cycles turn. In the end, the real edge in markets comes from understanding how the economic machine works and recognizing where we are in the cycle. When you align your decisions with those long-term forces, wealth becomes less about luck and more about structure. When most people hear the word silver, they think of jewelry, coins, or something stored in a vault alongside gold. That view is incomplete and often misleading. Silver is unique because it exists at the intersection of money and modern industry. This dual identity is what gives it strategic importance and what makes it fundamentally different from many other assets investors consider. For thousands of years, silver functioned as money. Long before paper currencies existed, silver was used as a medium of exchange, a store of value, and a unit of account. Empires minted silver coins, trade routes were built around it, and everyday commerce depended on it. That monetary role did not disappear because silver lost value. It disappeared because governments wanted more control over money. Paper currencies made it easier to borrow, spend, and manage economies in the short term, but they also removed the natural discipline that metals once imposed. Even though silver is no longer officially classified as money in most systems, it still behaves like money when trust in fiat currencies weakens. During periods of inflation, currency debasement, or financial stress, silver tends to regain attention as a tangible asset that cannot be printed or manipulated by policy decisions. This monetary characteristic alone gives silver a role in protecting purchasing power over long periods of time. What makes silver especially interesting today is that it is also one of the most important industrial metals in the world. Silver has unique physical properties. It is the best electrical conductor, highly reflective and naturally antimicrobial. These qualities make it essential in electronics, smartphones, medical equipment, batteries, data centers, and most importantly, solar panels. As the world becomes more digitized and more energy dependent, silver becomes more embedded in everyday life. Unlike gold, which is primarily stored and preserved, much of the silver used in industry is consumed. Once it is integrated into electronic components or solar cells, it is often too expensive or impractical to recycle. That means silver doesn't just sit above ground waiting to be reused. It gradually disappears from available supply. This consumption factor is critical because it quietly tightens the market over time. At the same time, global policy trends are increasing silver demand structurally, not cyclically. Governments around the world are pushing for electrification, renewable energy, and technological infrastructure. Solar power alone requires large quantities of silver, and this demand is not optional or speculative. It is built into long-term energy plants. As these initiatives expand, silver demand rises regardless of short-term economic conditions. This combination, monetary relevance and industrial necessity, is rare. Most assets are one or the other. Currencies rely on trust but have no physical constraint. Industrial commodities rely on demand but lack monetary protection. Silver has both. That means it can benefit from economic growth and from economic stress depending on which force becomes dominant. Another overlooked aspect is how little silver is held as a strategic reserve compared to gold. Central banks stockpile gold, not silver. Large institutional portfolios often ignore silver entirely. This lack of ownership doesn't reduce silver's importance, it increases its sensitivity. If silver were to regain monetary interest, at the same time industrial demand remains strong, the market would have to adjust rapidly. Silver's value is not based on a single narrative. It does not depend solely on inflation, technology, or fear. It sits at the crossroads of all three that makes it less predictable in the short term, but potentially powerful in the long term. Understanding silver, men's understanding that it is not just a metal and not just money. It is a strategic resource woven into both the history of wealth and the future of technology. That dual role is what makes it worthy of serious consideration in a world undergoing monetary and structural change. One of the most misunderstood aspects of silver is its supply. Many people assume that if prices rise, production will quickly increase and balance the market. In reality, silver supply is slow, constrained, and far less flexible than most investors realize. This creates conditions where even modest increases in demand can have an outsized impact on price over time. Silver is rarely mined on its own. The majority of global silver production comes as a byproduct of mining for other metals such as copper, lead, zinc, and gold. This means silver supply is not primarily driven by the price of silver itself. Even if silver prices rise significantly, mining companies cannot easily ramp up silver output unless it also makes sense to increase production of the primary metals. As a result, supply does not respond quickly or efficiently to changes in silver demand. Developing a new mine is a long and capital-intensive process. From discovery to production, it can take 10 years or more. Permitting, environmental regulation, infrastructure, financing, and geopolitical risks all slow the process further. In many regions, mining has become more politically and socially challenging, adding uncertainty to future supply. These realities make silver structurally scarce even before demand is considered. At the same time, above-ground silver inventories are much smaller than most people think. Unlike gold, which is largely preserved and stored, silver has been consumed in massive quantities over decades. Industrial use has steadily reduced accessible silver stockpiles once silver is used in electronics, medical equipment, or energy infrastructure. Much of it is lost permanently. This means the world has far less readily available silver than historical production figures suggest. Recycling is often mentioned as a solution, but it has limits. Recovering small amounts of silver from complex products is expensive and energy intensive. Recycling becomes economical only at much higher prices, and even then it cannot quickly replace primary supply. This creates a lag effect where demand can rise faster than supply can respond, forcing prices to adjust upward. Another important factor is energy. Mining is energy intensive and energy costs have become more volatile and in many regions more expensive. Higher energy costs raise the marginal cost of silver production, effectively increasing the price level required for new supply to come online. This adds another layer of constraint to the supply side. Geopolitics also play a role. A significant portion of silver production comes from a small number of countries. Political instability, regulatory changes, labor disputes, or trade restrictions in these regions can disrupt supply unexpectedly. These disruptions often occur with little warning and can compound existing shortages. When you combine these factors, byproduct dependency, long development timeline, shrinking above-ground inventories, limited recycling, rising energy costs, and geopolitical risk, you get a supply picture that is far more fragile than it appears on the surface. This fragility doesn't matter much when demand is flat, but when demand rises persistently, the imbalance becomes unavoidable. Markets tend to ignore these realities until they are forced to confront them. Prices remain suppressed until inventories tighten, delivery delays appear, and users begin competing for available supply. At that point, price moves are often sharp rather than gradual because the system has very little buffer. Silver's constrained supply is not a short-term story. It is a structural condition built into how the metal is produced and consumed over time. This creates the potential for significant revaluation when demand pressures intensify. Understanding this supply dynamic is essential for understanding why silver can remain undervalued for long periods and then move dramatically when conditions change. Throughout history, the relationship between money creation and real assets has been remarkably consistent. When governments and central banks create large amounts of currency, the value of that money tends to decline over time. Not necessarily in visible or immediate ways, but steadily in terms of purchasing power. This is not a theory. It is an observable pattern that has repeated across empires, monetary systems, and centuries. Money is supposed to be a store of value. But modern fiat currencies are not scarce by design. They can be created digitally in unlimited quantities whenever policymakers believe it is necessary to stabilize markets, fund deficits, or manage debt burdens. In the short term, this can prevent financial collapse and support economic activity. In the long term, however, it changes the value of money itself. When more money is created faster than real goods and services are produced, each unit of currency represents a smaller claim on real wealth. This doesn't always show up immediately as higher prices at the grocery store. Often it appears first in asset prices. Stocks, real estate, commodities, and precious metals rise not only because they are more valuable, but because the measuring stick, money, is becoming less valuable. This is why real assets play such an important role during periods of aggressive money creation. Real assets cannot be printed. They exist independently of policy decisions. Land is land. Metals are metals. Energy is energy. When currency supply expands, these assets tend to absorb that excess liquidity, preserving purchasing power in a way that paper money cannot. Precious metals have historically been among the most sensitive to this dynamic. Gold is often the first to respond because it is widely recognized as a monetary hedge. Silver, however, has often followed with greater volatility because it is a smaller market. It doesn't take much capital shifting out of cash or bonds to create significant price movement. Another important factor is interest rates. When central banks print money, they often keep interest rates artificially low to manage debt servicing costs. Lower negative real interest rates punish savers and reduce the opportunity cost of holding non-yielding assets like precious metals. In these environments, holding cash becomes less attractive, and holding real assets becomes more logical. Currency printing also affects trust. Money works because people believe it will retain value in the future. When debt levels rise and money creation accelerates, that confidence can weaken. Even if inflation is not immediately visible, people begin to question the long-term stability of the system. That shift in psychology can be just as powerful as the economic mechanics themselves. When trust erodes, capital seeks safety. Historically, that safety has often been found in tangible assets with long-standing monetary credibility. Silver benefits from this not only because of its history as money, but because it remains accessible to individuals. It represents a form of savings outside the financial system, free from counterparty risk. It's important to understand that this process is gradual, then sudden. For long periods, money printing appears harmless, markets adapt, confidence remains, and prices move slowly. But once certain thresholds are crossed, when debt becomes unmanageable or currency creation becomes normalized, adjustments can accelerate. At that point, the repricing of real assets is not speculative, it is corrective. This is why focusing only on short-term inflation data can be misleading. Currency debasement is a long-term phenomenon. It shows up over decades, not months. Those who wait for obvious signals often miss the most favorable positioning. Real assets are not about betting against the system. They are about recognizing its limitations. No monetary system in history has survived unlimited money creation without consequences. The form those consequences take may vary, but the underlying principle remains the same. In a world where currency supply continues to grow faster than real output, holding assets that cannot be created at will becomes less about opportunity and more about necessity. Silver as a real asset with both monetary and industrial relevance sits directly in the path of this long-term force. One of the most powerful but least understood concepts in investing is asymmetric risk and reward. Asymmetry exists when the potential upside of an investment is significantly larger than its potential downside. Silver fits this profile largely because of the size and structure of its market. Compared to major asset classes like stocks, bonds, real estate, or even gold, silver is a very small and thinly traded market. That smallness is not a weakness, it is the source of its explosive potential. Because the silver market is relatively small, it does not take enormous amounts of capital to move prices. Large asset classes can absorb billions of dollars without dramatic price changes. Silver cannot. When even a modest portion of global capital shifts its attention towards silver, the impact can be significant. This creates a dynamic where prices can move rapidly. Once intake, rest begins to build. Most of the time silver is ignored. Institutional investors rarely allocate meaningful capital to it. Central banks do not hold it as a reserve asset. Pension funds and sovereign wealth funds generally view it as too small or too volatile to matter. This lack of participation keeps prices subdued, but it also means the market is not crowded. When sentiment changes, there is no deep pool of sellers waiting to meet new demand. Volatility is often seen as a risk, but in small markets, volatility is also a signal of potential. Silver has a long history of sharp moves both up and down. These moves are uncomfortable for traders, but they are exactly what create outsized returns over full cycles. The key is not to trade the noise, but to understand the structural conditions that can lead to revaluation. Another element of silver's asymmetry is its cost structure. Mining silver is capital intensive and energy dependent. There is a natural floor beneath prices because production cannot continue indefinitely below cost, while prices can temporarily dip due to sentiment or macro conditions. Prolonged periods below the cost of production tend to reduce supply, setting the stage for future price recovery. This helps limit long-term downside. On the upside, however, there is no comparable ceiling. If monetary conditions, industrial demand, and investor psychology align, silver prices can rise far beyond what seems reasonable in the present. This has happened before. Historically, silver has experienced periods where it dramatically outperformed gold and other assets in relatively short spans of time. The gold-to-silver ratio is often used to illustrate this potential. For much of history, silver has been valued at a much lower ratio to gold than it is today. When that ratio compresses, it often happens quickly and violently, driven by capital rotation rather than gradual adjustment. These shifts are not predictable in timing, but they are predictable in nature. Another reason silver's upside is asymmetric is accessibility. Silver is affordable at the individual level. This allows retail participation during periods of rising interest. When demand spreads beyond institutions to individuals seeking tangible assets, the effect on a small market can be dramatic. Physical demand can tighten availability quickly, amplifying price movements. Importantly, asymmetry does not mean certainty. Silver is not guaranteed to rise, and it can remain undervalued for long periods. That is the cost of optionality. Investors who understand asymmetry accept periods of frustration in exchange for exposure to rare but powerful outcomes. The mistake many people make is evaluating silver as if it were a large, stable asset class. It is not. It behaves more like a pressure system. For long periods, pressure builds quietly, unnoticed and dismissed. Then when conditions change, the release is sudden. Silver's small market is precisely what allows it to respond so dramatically to shifts in demand. In a world where capital moves quickly and narratives change fast, that characteristic gives silver a unique place among real assets. It offers limited downside relative to production realities and potentially significant upside when cycles turn, which is the essence of asymmetric opportunity. One of the biggest misunderstandings about silver is the belief that it is a shortcut to wealth. That mindset often leads to disappointment, poor timing, and emotional decision-making. Silver is not a lottery ticket, and it is not designed to make anyone rich overnight. Its real value lies in its role as a tool for resilience, balance, and long-term risk management within a broader portfolio. Every investor faces uncertainty. No one knows whether the future will bring inflation or deflation, growth or recession, stability or crisis. The mistake many people make is concentrating their wealth in assets that perform well in only one environment. When conditions change, those portfolios suffer. The goal of intelligent investing is not to predict the future, but to prepare for multiple possible futures. This is where diversification becomes essential. True diversification means holding assets that respond differently to different economic conditions. Stocks tend to perform well in periods of growth and stable money. Bonds can provide protection in deflationary slowdowns. Real assets, including silver, tend to perform better when inflation rises or when confidence in currencies weakens. Each asset plays a different role, and none should be expected to do everything. Silver's role in this structure is unique. It provides exposure to a hard, tangible asset that exists outside the financial system. Unlike stocks or bonds, silver does not depend on earnings, management decisions, or promises to pay. It has no counterparty risk. Its value does not rely on someone else's ability to meet an obligation. That alone makes it a powerful stabilizing element during periods of financial stress. At the same time, silver's industrial demand gives it relevance even in non-crisis environments. This differentiates it from purely defensive assets. When economies grow and technology expands, silver benefits from increased usage. When economies struggle and money is devalued, silver benefits from its monetary characteristics. This dual behavior allows it to contribute to portfolio balance across a wide range of outcomes. Another important aspect of resilience is psychological. Volatile markets test investors emotionally. Assets that move sharply can trigger fear and greed, leading to poor decisions. Holding silver as a strategic allocation rather than a speculative trade helps avoid this trap. When silver is viewed as insurance rather than a bet, price fluctuations become easier to tolerate. Risk management is not about avoiding risk altogether. It is about avoiding catastrophic loss. Silver is not risk-free, but it can help reduce the overall risk of a portfolio by providing protection against scenarios that are otherwise difficult to hedge. Currency debasement, systemic financial stress, and loss of confidence are examples of risks that traditional assets often fail to address effectively. It is also important to recognize that resilience is built over time. Silver may underperform other assets for long periods, especially during strong equity markets. That does not mean it has failed. It means it is doing its job quietly, waiting for conditions where its value becomes more apparent. Insurance always feels unnecessary until it is needed. The danger of hype is that it encourages all-or-nothing thinking. When silver is promoted as a guaranteed path to wealth, people tend to over-allocate, take excessive risk, and lose discipline. When expectations are not met quickly, they exit at the wrong time. A disciplined approach avoids this cycle by treating silver as one component of a thoughtful strategy. Ultimately, wealth that lasts is built on balance, not extremes. Silver fits into that philosophy, not as a promise of riches, but as a contributor to durability. It helps protect purchasing power, diversify risk, and reduce vulnerability to systemic shocks. In a complex and uncertain world, resilience is a form of wealth in itself. Silver's true value lies not in dramatic headlines, but in its ability to strengthen a portfolio across cycles. When used with patience and discipline, it becomes less about chasing returns and more about staying solvent, stable, and prepared. Qualities that matter far more over the long